So starting with a new chapter called ratio analysis. I request all of you to pay attention. Starting with the ratio analysis, new chapter. As far as the word ratio is concerned, it is indicating certain financial values or non-financial values for an organization. For example, we make the calculation of current ratio. Now, what do we understand with the term current ratio? Current ratio is indicating amount of current assets for every 1 rupee of current liability. I request all of you to pay attention, don't write anything. Current ratio is found as current assets upon current liabilities. What is the current assets? Let us say it is an amount of 10 lakhs and the current liability is, let us say, an amount of 5 lakhs. So the answer is 2. What does this 2 indicate? This is indicating that the current assets is 2 times of the current liability. So for every 1 rupee of the current liability, current asset is 2. That is what this ratio is indicating. So basically the ratios are used to have some interpretation of the values that we have with our financials. There are different purposes with which you will calculate the ratio. We understand that a bank wants to decide whether to give loan to a company or not. Then in that case the bank will make the calculation of interest coverage ratio. Bank will make the calculation of debt service coverage ratio. These are the ratios that the bank will calculate. Why? Because interest coverage ratio will give an idea to the bank that what amount of the operating income that the company will have for making payment of interest. Debt service coverage ratio is indicating what is the ability of the company to make the payment of interest and principal. So this is what something that you will be able to calculate using these information. Next, don't write anything, let us understand. There will be certain ratios that will measure the profitability of the company. In a way that we understand that to measure the profitability, maybe from the management point of view, maybe from the investor point of view, profitability is something which is everybody would like to know. So it is gross profit ratio, net profit ratio, return on equity, return on capital employed, return on investment. Like these are the profitability ratios that can be calculated to measure the profitability of the company. Then from investor point of view, dividend yield, then earning yield, then we are going to understand net fund flow. These are certain ratios that we are going to calculate from investor point of view. Next, we will be having certain ratios from activity ratios. Basically, the management of the company would like to know that how effectively we utilize the investment that we have made in the business. And for that, we have certain activity ratios. It is called debtors turnover ratio, creditors turnover ratio, then total asset turnover ratio, fixed asset turnover ratio, working capital turnover ratio. So these activity ratios will help the management of the company to draw a conclusion that how far we are using the assets of the business. Then to measure the liquidity, we have certain ratios like current ratio, liquidity ratio, absolute cash ratio, cash position to total assets ratio, and cash interval or cash defense ratio. What I want to tell you is that there may be different purposes with which you are making the calculation of the ratio. In a way that, say, suppose one of your customer is approaching to you and asking that, say, I want to buy goods from you on credit. Then in that case you will see that, say, how are the liquidity ratios, and based on that, say, you will draw conclusion that whether goods should be sold to that company on credit or not. Like that, say, we are having, say, certain ratios to be calculated from the different point of view in this way. So basically, whatever the purpose that you have, for that purpose, you will make calculation of the ratios. As I told you that, say, certain ratios are calculated from bank point of view to determine whether loan should be given to a company or not. Certain ratios are calculated from management point of view. Certain ratios are calculated from investor point of view. Like that, say, we would like to make, say, these calculations. What we are going to learn, dear students, we are going to learn initially all the ratios, starting from GP ratio, NP ratio, all ratios. Afterwards, we are going to solve the questions which are usually asked in examination, that is missing information question. Yes, dear students, what happens that, listen carefully, dear students, what happens that in examination, most of the time we are provided with the questions in which we are required to find the missing information. Means you will be provided with, say, certain set of the information, and based on that, say, you are required to complete the financial statement, starting from the trading account, P&L account, and balance sheet. That is the kind of questions which are usually asked in examination. And of course, sometimes we are provided with the questions in which these ratios are to be calculated. Importantly, the missing information questions you will be able to do successfully once you have a grip on all these ratios, because all these ratios will be used for the purpose of extracting the information. That is what we understand. Let on heading ratio analysis. In that, write down first point. In this chapter, we are going to learn calculation of ratios and preparation of financial statement. Second point, ratio is indicating a financial or non-financial situation. Full stop. For example, current ratio indicates current ratio indicate that what is current assets for every 1 rupee of current liability. It is part of liquidity ratio. Full stop. Third point, for different purposes, comma, different ratios are calculated, and based on that we can draw conclusion. So for example, we have computed that the interest coverage ratio is 5. So that indicates a sound financial position, that for every 1 rupee of the interest to be paid, the company has 5 rupees. Then let us say that so the debt equity ratio is 0.80. Means for every 1 rupee of the equity, debt is 80 paise. So all these things that shall be able to know, say with the ratios. We will initially learn ratios, and based on that later on preparing financial statement. Full stop. This is what we are going to understand. Friends, there is a big list of the ratios that we are going to learn. So I'm not dictating all of them to you. We are starting with one by one question, and in that we are going to have the discussion. Let us see our question. Consider following information. Debtors are an amount of 2 lakhs of rupees. Cash and bank is 2 lakh. Stock is 1 lakh 50,000. Creditors is 3 lakhs. Bank overdraft is 1 lakh. Cash credit is 75,000. Prepaid expenses are 25,000. You're required to calculate. There are 4 questions. Current ratio, and it has a different name called working capital ratio, and so on. Further questions are there. I request you to write in the chat box what is the current ratio, which is also given a name as working capital ratio. So friends, for the purpose of calculation of the current ratio, current assets will consist of debtors, cash and bank, stock, then prepaid expenses, and current liabilities are consisting of this three. Should I write an answer? Current ratio, it is current assets upon current liabilities. So basically the current ratio is indicating what is the amount of the current assets for every 1 rupee of the current liability. It is debtors plus cash and bank plus stock plus prepaid expenses, whole divided by current liabilities. As far as the current liabilities are concerned, it is creditors plus bank overdraft plus cash credit. That is the way we'll compute the current liability. Dear students, a kind of definition of the current assets is that portion of the assets of the company which will be converted into cash within 1 year. And current liabilities means those liabilities which are required to be paid within 1 year. So amount of the debtors is an amount of 2 lakhs. Cash in bank is again 2 lakhs. Amount of the stock is 1,50,000. Prepaid expenses are 25,000. Whole divided by that is creditors 3 lakhs. Bank overdraft 1 lakh. Cash credit 75,000. That is what we have. So it is 2 plus 2 4, 4 plus 1 5, 5,50,000 plus 25,000. So 5,75,000. Whole divided by current liabilities. 3 plus 1 4, 4 lakh plus 75,000, 4,75,000. That is the way the current ratio is found. 575 upon 475. So it is 1.2105. So this current ratio is indicating that say what amount of the current assets that we have for every 1 rupee of current liability. Please write down answer. First point, current assets means that portion of assets of the company which can be converted into cash within 1 year. Second, CL, current liability, means that portion of total liability to be paid within 1 year. Full stop. Friends, over here there is a word that say they have used cash credit. I just give an explanation of the cash credit. Cash credit is very similar to the bank overdraft, wherein you are having a sanction limit and so you can overdraw your account say to that extent. That is what say we understand is a cash credit. Usually stock is given say for the security for the purpose of obtaining the cash credit limit. Bank overdraft is similar to that. Usually in that the fixed deposit is given in form of the mortgage for the purpose of say taking the bank overdraft facility. This is what say we understand. Now one important thing that say I want to discuss with all of you is this. Generally students have a point that say the current ratio should be greater than 1. Only in that case say it indicates the sound financial position of the company. However friends, this is not correct. Any company should have the current ratio which is near to the industry ratio. If at all in the industry everybody is keeping 5 and you keep only 2, then it is poor. If at all everybody is keeping the current ratio 0.75 and you keep let us say 0.90, it is good. So basically to determine say which company has introduced proper current ratio or which company is maintaining proper current ratio, we always have to refer to the industry data. If at all it is substantially more, then in that case it is indicating the sound financial position, but at the same time it shows like mismanagement of the working capital. Because if at all everybody is keeping 2, then why do you keep 5? If at all you keep 5, then in that case it shows that say you are having excess investment in current assets which will keep your funds blocked. and in that case your carrying cost will be more. So you should not be having substantially more than the market, neither you should be having so substantially less. This is what we understand. Right, on third point, a company is considered to be having proper current ratio, comma, which is near to industry. Full stop. Any ratio more or less than industry is improper. Full stop. Second question is calculation of the quick ratio or liquidity ratio or asset test ratio. I request you to give answer for the second question in the chat box. Friends, as far as the quick ratio or liquidity ratio asset test ratio is concerned, it is a kind of extension of the current ratio. Please write down answer. Quick slash liquidity slash asset test ratio. Dear students, it will be calculated like this. Understand carefully. It is quick assets divided by current liabilities. As far as the quick assets are concerned, it is calculated as current assets minus stock, because they have a contention that say the stock is not easily convertible into cash. That is the reason say the stock is limited, minus prepaid expenses. A kind of argument is made over here is that say the prepaid expenses are not cash convertible. That is the reason the prepaid expenses are deducted, divided by current liabilities. As far as the current assets are concerned, we already have found it, 5,75,000 minus stock. Stock is 1,50,000 minus prepaid expenses 25,000, whole divided by current liabilities, which is 4,75,000. That is the way it is calculated. So 5,75,000 minus stock is 1,50,000 minus 25,000. So the numerator is 400. So as far as the current assets are concerned, sorry, quick assets are concerned, it is 4 lakhs and current liabilities are 4,75,000. So the answer is 0.8421. Dear students, we are required to take in the division current liability. Many a times the students are having a point that say they take current liability minus bank overdraft. However, it is wrong. We are required to take current liabilities, which is 4,75,000 in this example. I request you to give answer for the third and fourth question in the chat box. Working capital and gross working capital. So friends, we'll make the calculation of the working capital as the difference of the current assets and current liabilities. And the term gross working capital means only current assets. That's it. So write down answer the question. Answer for the third question. In that working capital, the term working capital stands for investment in current assets net of the current liabilities. Working capital, in that write down, working capital means investment in current assets net of current liabilities. Full stop. It is calculated as under. In that breakdown, working capital is current assets minus current liabilities. 5,75,000 minus 4,75,000. And the answer is rupees 1 lakh. That is the way the working capital is formed. Fourth question, in that is the gross working capital. In that write down, gross working capital means only current assets. Full stop. It is rupees 5,75,000 in this example. Write down answer. So summary of the answer. In this question we are having the liquidity ratios to be calculated. The first one is the current ratio, that is all current assets minus current, that is divided by current liabilities. 1.21. Number of times it is also written as 1.2105 is to 1. But when it is mentioned is to 1, that does not make any sense. It only says that this is the current assets for every 1 rupee of the current liability. Definition of the current assets and current liabilities are, these are supposed to be received or paid within 1 year. Higher the current ratio is indicating that the good liquidity position and vice versa. Yet we can say that when a company is considered to be deemed to be having correct liquidity ratios when it is near to the industry, neither it should be substantially more nor it should be substantially less. If it is substantially less, then in that case there will be liquidity issue. There are fair chances that it may happen that we are required to make the payment to the current liability and we don't have the sufficient funds. And the second is, we understand the quick ratio or liquidity ratio, in which the quick assets upon current liabilities and not liquid liabilities. There are two things which are excluded in calculation of the quick assets. One is stock and another is prepaid expenses, because they have an argument that the stock is not easily convertible into cash. And the second, prepaid expenses are deducted because the prepaid expenses are not cash convertible. Working capital simple, difference of CA and CL. Gross working capital is only current assets.